Good afternoon. This is Chris Robinson, Robinson Ag Marketing with today's post-close grain and livestock comments for today, Wednesday, the 22nd, 2025. I covered some of this stuff earlier in the day in my letter, which went out this morning. If you're not getting my letter, feel free to sign up for it. It comes out every morning. And then on the weekends, I do a really lengthy, about 15 or 20 charts, big weekly lookout. So take a look at that. If you like it, let me know. Today, uh, well, just another day full of tweets. I try and stay non-political. There's enough people out there that are political. So let's just say this: that yeah, there was a tweet today from the president, and rubbed a lot of people the wrong way, especially in the cattle industry. Um, at the end of the day, this is the world we live in, and price discovery is what we're here to do, and we're here to manage risk. Um, Peter, needless to say, there's no new package yet that they've announced. We were promised it, but it didn't show up. There was no confirmation yet that they will have the meeting at the end of the month with Xi and Trump in South Korea. We will have to wait and see. And I'd say it's probably 80-20 it gets done. Right now, they're having meetings about having the meetings, right? So we'll see. I think it's just more negotiation leverage. At the end of the day, though, what happened? Just a quiet, kind of two-sided choppy trade in the corn and wheat and beans. Corn finished up 3 cents at 423. I discussed the fact of the importance of these technical levels in corn, especially the 100-day moving average. November beans finished up 4 cents at 1034 and 3/4. We had a 10-cent trading range. Once again, however, we cannot get through the little wedge. And if you aren't wondering about what I'm talking about, again, take a look at my letter. I break down those technicals. For whatever reason, there's a little wedge there. There's a little trend line there around 1040, which is holding us back. Um, if you look at the open interest, which has dropped, you can see a lot of this rally was short covering rally. We also know that the managed money, or we have a really good estimate that the managed funds, the managed money is long now. They're not long a ton, maybe 15,000 contracts. It's not like, they've got a couple 100,000 on something crazy like that. But so they're long soybeans, they're long bean oil. They're still short 100,000 meal, 100,000 corn, 100,000 wheat, which if anything changes, they may have to buy those back. So it's something we look at with my producers. We want to be in a position that if we do get a good rally, if we do hit our cash sale targets, that we've got the grain to sell. This game's all about making good cash sales, and that's the way I approach it for producers. Protect until you sell, and then you can always re-own it after you sell. But the key is to look for good levels to sell and be ready to sell it when we get there. Don't have yourself hemmed up in some min max thing or double up thing where you're getting run over because what seemed like a really good hedge, um, it turns out to not to be one. So November beans. I talked in my letter this weekend, and I've talked about it for the last month or so. We're getting into. We're going to figure out what the fall insurance price is. We're figuring that right out right now. I will say this, just from a marketing standpoint, to be sitting here at 1034 beans when we've had a high in the year of 1079, 1075 and 3/4, and a low of 971. We only had $1 for to work with. Anything north of 1041 and 1/4 puts you in the upper third. Now that's based on what the flat price is on the board. I get it. Your basis is usually worse than that, but I base all my hedges and my cash sales on the cash board. I can't do anything about your basis. But we're closing out on that. I mean, for all the fretting and the hemming and hawing, we're $1 plus higher than what we were this time last year. I think what's driving most people to be upset is the fact that inputs are high. And so it's not the same math problem what we were in last year. And having China sit on their hands and not buy their usual billion bushels has definitely impacted price discovery for sure. And I think the reason the funds are long right now is because they're looking for some sort of a deal where China would say, okay, come back, we'll buy it all. And if that would happen, you'd get paid if we get a good rally. And, I've got cash sale targets up there at 1070 in the 1070 area, 1066, 1070, 1075. I hope we get up there. I want to sell the beans if we do. Or if you can't bring yourself to sell the beans, then we're going to be hedging aggressively with puts if we get that roll up there. In the meantime, looking at December Chicago wheat, I can't stress it enough. There's a stupid trend line there that goes back to July. We couldn't get above it today either. We went right up to it. Couldn't get through the 506 area. We did settle at 503 and three quarters. I don't spend a whole lot of time wondering why these lines matter, these imaginary lines, and on the charts. It's just trend line. You take one old high and draw it to the next old line with a ruler. But it is the market that we're trading right now. So these wheats right there, all it needs is a reason for these funds to come away from their short position. It would be nice if they were forced to cover all shorts because that would mean their buying would help drive up the prices. We just need the story. We need the narrative. All right, let's move over to the fat cattle and the feeder cattle. Feeder cattle finished down limit, down 929.250, 364.225 in November. We never got back up into that gap from Friday. We've been watching that all week. The synthetic, if you look at the options, so if you were trapped long futures today, you could have gone over and what you do is you buy a put and you sell a call at the same strike price. And that creates a synthetic short because you sell the call, you buy the put. When you sell the call, you buy the put, you're creating a synthetic short future, which is how you stop the bleeding if you're long and you're locked limit. And that calculation was showing that the flat price was trading even at about $1.25, $1.30 lower. So we were trading at 964 and change. The synthetic suggested we were down around 962.70, excuse me, 362.70, 363 area. This thing could all change tomorrow. We never, like I said, we never got the information today. We're looking forward to the big package deal that they're trying to put together here. It weighed on the hogs as well. We had a little bounce in hogs yesterday. Hogs finished almost $1 lower. Dees traded at 82.40 as low as 82.30. That is a new kind of a pullback. Yesterday we traded 84 cents. I would say this: if we take out 82 cents, it opens up the door for a run back down, possibly to the July low at 78 area. So we're hedged. If you're working with me, we're hedged, and we have been rolling down puts where we can take value on those. So another strange day, another day dominated by tweets. I know it's depressing. I get it. I'm here with you every day, watching the same markets you are. My advice continues to be defend, defend, defend. If you're storing grain, don't just store it and ignore it. Keep a cheap put under it. Yes, there is still downside risk if we don't get a weather issue. The world has too much of what we have produced, really, when it comes right down to it. And people talk about the fact that China has not been in the market. Part of the reason is they don't have to be. They've bought a ton of beans from South America. They probably overbought actually, and their economy is also suffering. They have their own internal issues. So if we can get this trade deal worked out, I think it would be the blessing for both sides. I'm always a glass half full person, but I think it's going to be a bumpy ride until we get this settled, and it's going to be spiked by these. One day we get a nice tweet, the next day we get a bad tweet. It's like waking up with Santa Claus every day. So that's about it. This is Chris Robinson. If you're looking for help, first of all, sign up for my letter. I did send out the private client webinar last night. Spent about a half hour going through 13 different charts. And it really gives me a chance to kind of teach a mini class about, not that I'm, some Nobel Peace Prize winning person. It's just I share the stuff that I've learned since I started in this business in 1991, and hopefully you can pick something up from it. It's like everything else. Take a look at it. If you think there's value to it, let me know. I work with farmers and producers. I have since 2010. Prior to that, I spent 18 years trading at the board trade. Started in the mid-am and traded in just about every pit that was down there. I focused a lot of my time, though. I did trade in the soybean pit, and also I spent about 7 years in the Dow pit. So that's my background. I work with farmers and producers. I try and set the best hedges for you to defend your risk. At the end of the day, if we knew where the markets were going to go, or if we had some secret AI computer that could tell you where the highs and lows were, then you wouldn't have to hedge at all. But since we don't, we hedge. All right, there's a good night. This is Chris Robinson. Take care.